favor of the losers.
Let's connect with him to understand what his current market view is and why the strategy report, which has hit our mailbox on 27th of April, talks about will commodity prices hit EPS, yes or no? So, Vikas, I can see somebody moving behind you.
Yeah.
Are you good to go?
Yeah.
All clear?
Yes.
Okay, wonderful. It's not all clear for the markets. Global cues, FI selling, inflation, it's not clear for the market which way things are moving in the short term.
Sure. So that's right. I mean, it's generally never all clear. It's just maybe this time there are a little bit more hurdles than what we are used to. So from that perspective, yes, we need to live with them. I think if you look at the current market setup and the current setup in India, the popular worry that most foreign investors have is that India is very expensive versus other markets. And a lot of that is maybe colored by the fact that they're comparing it versus EM benchmarks or AsiaX benchmarks, which have an impact of what has happened in China as well as in Russia. However, even on an absolute basis, yes, valuations are not supportive. But the way to look at it is that if we look at more bottom-up perspective, and this is what we did very recently when we looked at, Nifty is made up of about 50 stocks. Only 1/4 of them are trading at over 50% premium, or where you can say that they're significantly higher. There is actually nearly half of Nifty which is trading below its historical average valuations. So it's really that, there is still opportunities which are there. I think this is something that we've maintained right from the start of the year. This will be a year where benchmark returns would be rather difficult to get, but it is a year where sector rotation will be far more important, and that's what we need to focus on.
Let's understand the impact what NASDAQ or reversal in US equities could have. I mean, the most crowded trade in the world, which is the so-called long FANG, is reversing or has already reversed. What implications do you think this could have on liquidity and emerging market equities?
See, I think this is not something which has started just yesterday, although I know that there were many of these stocks which have been correcting. In fact, our report right at the start of the year, around 4th, 5th January, is where we highlighted that if we look at history, twice in the last 20 years, Fed's interest rate cycle is turned. In both of those instances, for the first 50 bips hike and the first 100 bips hike, technology has underperformed banks very clearly. And I think that's a similar thing which has been playing out over since January. In fact, what people have forgotten is before the war, there was a NASDAQ crash that we faced in January. And I think it's just as as investors are digesting the risks around war, those risks again come back to the forefront, particularly because we are just at the footsteps of another big hike by Fed. So I think rising yield is a reality. Rising commodity prices is a reality. We'll have to guide our portfolio through these worries and maybe look at potential winners of this. Rising yield is good for value, not good for expensive growth. That's why many of the technology sector in India, which is versus its history, is at a significantly big premium. We've not been liking that sector. That's a big underweight in our focus portfolio, right? Over the last 6 months or so. And we've been focusing much more on value. In fact, our focus portfolio, the PE of that portfolio is almost about a 40% discount to what Nifty PE is. So it's clearly, which just tells you that it has a huge value bent in that focus portfolio.
Right. But Vikash, the point really is, and going back to what you were earlier talking about on whether or not the commodity prices are going to hit the Nifty EPS or not. The two of the largest sectors which make the Nifty, that's IT and banks, they don't have any direct correlation to commodity price uptake. So, I mean, the question really boils down to it's largely FMCG consumption, which is going to get impacted by commodity prices.
That's right. See, I think the report that we came out with, and the one that you're referring to just today, is taken a scenario that we don't get into significant third derivative impact of, big spike in commodity prices leading to a huge slowdown globally. As long as that doesn't happen, then impact on banks and IT is much more limited. So far, we are not really building that kind of a scenario. In fact, to some extent, higher commodity prices means being more inflationary could lead to higher working capital requirements, which could be good for banks in terms of credit needs, in terms of working capital credit needs rising. That could be an at the margin positive. Essentially, direct impact on these is much lesser. But what is happening is these commodity consuming sectors, or the ones which are dependent on commodity as an input, are facing multiple headwinds. First, these are the stocks which are at much elevated valuations versus the market in general. So in a rising yield environment, like we discussed, that's anyways not good for them. Secondly, consumer confidence, as measured by RBI themselves in India, is at one of the lowest readings, other than the bottom that we saw around COVID, versus its own 10-year average or pre-COVID levels. In fact, the variance from pre-COVID or 10-year average in consumer confidence is one of the worst in India as compared to most of the other top 14, 15 economies that we see. So that anyways is not very, doesn't build a lot of confidence on demand. And finally, is the impact on margins that that commodity price inflation could have. So you have worry on demand, you have worry on inflation, as in margins because of commodity price. And finally, you also have the rising yield environment, which could attack high multiples. So that's a space that we are quite wary of. In fact, we have only one consumption name in our focus portfolio out of 13 stocks that we have in the portfolio. And that too is a relatively more value name in terms of that sector. So clearly a space that we are not too confident about.
Right. That's quite interesting. So Vikash, I mean, for the investor out there watching this interview, I just wanted to understand what the portfolio breakup sectorally should be and what levels of cash should one have, keeping the powder dry for when the market corrects further or when you find an opportunity to invest in the market.
See, I think the cash bit is always more difficult. The portfolio that we have is assuming that whatever is the equity exposure that one wants to put into, how should that be allocated? However, having said that, if we look at the way the market is moving and the valuations and how extended they are, there will always be opportunities coming from time to time. Like I started by saying that this will be a year when benchmark returns could be way more limited. So it is year when you look at the right sectors to focus on. And that's essentially the way we think about it. And the right sectors that we are focusing on are banks and commodities. So that's the sectors that we are focusing on. The sectors that we do not like are consumption and technology to some extent. So that's really how our portfolio is positioned.
Vikash, good morning. This is Nantara joining in. I know you used to track energy very, very closely and Reliance Industries. Now, what we've started to, of course, see is, the comeback of the Reliance Industries stock. Green hydrogen is being seen as a big play. We can see what's happening with the Adani Group as well on that front. So with the green hydrogen theme and the comeback of Reliance Industries, what is your view?
See, I mean, let's not, I don't really want to get stock specific here. I continue to track energy. And the key driver over the last 10 days or so has been the spike that refining margins have seen over there, which has also helped many other refinery stocks and has also helped, even conglomerates who have refining businesses. So I think that's been the driver for the recent stock price, which is a sector which wasn't really a big trigger, but it has become a trigger.
Okay, so that's become the trigger as far as Reliance Industries stock goes. You said you've continued to like financials. We've seen what's happened with the private sector lenders, the rotation also that's taking place. But the momentum that's now coming in with the smaller names, is that something that you folks like?
See, at this juncture, we still believe, so maybe you can divide this into 3 or 4 sub buckets. There is a more retail kind of bank, which was anyways doing well even before 2017-18. Then there are some of these corporate banks, corporate private banks, and then there are smaller banks, and finally there are PSU banks. Now we are right now more focused on large corporate kind of banks. And that's where we are comfortable. Of course, that could also mean that one of the amongst the larger PSUs, but we are not really confident enough to go further down on that yet, or we do not see the need also, because we still see enough opportunity in the large corporate side of banks, because a lot of these saw pretty long derating through a large part of the last decade, when there was a long balance sheet deleveraging cycle that they were going through. So it's really a kind of a mean reversion, as a worst part of that balance sheet worry is behind us and their performance is clearly improving. On the other hand, there are some retail banks which have become very expensive, and they are seeing some kind of maybe mean reversion in their valuations. So large corporate banks are the ones that we prefer.
Okay. Now what is going higher is Reliance Industries, 28.15. I mean, to put context for our viewers, Vikas, no, I'm not coming to you back on Reliance. I'm just making a point for our viewers here that $1 GRM uptick broadly translates into a $4 EPS upgrade. Now that is the kind of upgrade which some of the refining companies will have. Some of the companies, the inventory gains are going to be huge in this quarter. So there is going to be, if you're on the right side of the commodity, the quarter gone by really would be a super quarter. But if you're really on the wrong side in terms of inventory, or in terms of where are you in terms of supply chain, the adjustment in a sense is going to be very sharp. That's Reliance for you. It is up 40% in last 52 weeks. I mean, it has underperformed massively. Now it has come back also very smartly. The stock is at a new record high, and 28.17 for Reliance Industries. Because I want to go back to that point on banks. While banks will benefit if earnings and credit cycle starts, if working capital requirement will go higher because of high commodity prices, but ultimately if interest rates will move higher, it will have an impact on demand. If demand comes down, it will have an impact on everything. So how far are we away from a demand crunch? Because a demand crunch will happen sooner than later.
Well, I mean, there are many indicators which are not very encouraging. For example, we've already seen the yield curve, get into an inverted yield curve in the US. Typically, these have been indicators that we get into a severe growth slowdown. However, generally what we've seen, it's taken an average of 1.5 to 2 years from the point that it happens. So perhaps we still have a little bit more time left before that happens. But the other thing is, if we also look at commodity prices, and if we look at a more broader kind of a situation in terms of historically, the spike reached levels that it can cause, that it will cause recession, for example, the way we had in 2008 or the way we had in the 70s. On various parameters, we've not yet reached that kind of levels, if we look at where global GDP is. So perhaps there is some more way to go before we reach that point. But yes, I mean, eventually, if we have such kind of a situation where all central banks are going to tighten, then that, unless, typically to get a soft landing with that is not very easy. And, so that's a risk which clearly is a medium-term risk, which one cannot ignore. But my personal opinion is that we're still maybe some months away from that becoming a huge risk for markets.
Okay. The breadth is also not looking bad at all. So 17,000 on the Nifty actually is intact. Because there is one theory which says that, look, when the adjustment in the world starts, it will start first with money market, then it will come to the currency market, and then it will come to the equity market. So the money market adjustment is over. Currency has already started moving, and now equity market sharpish adjustment is left. I'm asking a very basic question, perhaps based on market history. Do you think history will repeat itself and the casualty now could be equities in the second half?
See, I think when we say equities, it's really which benchmark we are looking at. If we look at the kind of correction that expensive growth stocks have seen, that is, read that as NASDAQ, from their highs that we saw in December, January, that's quite serious. If we look at the kind of correction that China and some other markets have seen, that's pretty serious. So I think if you look at the last quarter and what all the market has absorbed, a kind of a massive crash in NASDAQ is how we started January. Then we got into a war. Last quarter was record FII selling. In fact, at the end of March, if you can pick and choose your time horizon, 3 months, 6 month, 9 month, 12 month, any rolling 3 month, 6 month, 9 month, 12 month period, if we see and if we look at history, FIs had not sold more than what they had sold at the end of March. So from that perspective, the market actually ended up, slightly a little less than 1% higher. So it has absorbed a lot. Basically, sector rotation is the way it played out. And I think perhaps that's something that we should, in a way, take into saying that why do we say that equities have not been reacting? If you look at some of the more expensive growth sides of the market, they have reacted pretty violently. In fact, if you look at NASDAQ and some of that, that reaction has happened. It's just that sector rotation has masked it on more generic indices that we look at, whether it is the S&P or Nifty.
How much of re-rating do you think is still left in the so-called value space? Because that now, what was in a sense the ugly duckling has now become the craze. Now everybody is trying to hunt with a magnifying glass what is cheap. Sasta kya hai? Let's go and buy it, because that is where the re-rating is happening.
See, I think that is something which is not happening from now. I think that's been the theme of this market right from post-COVID. See, a large part of the recovery that happened after COVID hit us was that many central banks, not lesser so in India, were actually taking actions, or governments were taking action, which was kind of percolating down to belief that this will lead to genuine economic growth coming back. That kind of confidence was lagging or lacking for a large part of the last decade. When that confidence was lacking, I mean, imagine this year, we are going to end with a Nifty EPS of growth of almost about 40%. I mean, the last year we ended FY22 by the time we get the results. That's pretty big. In an environment when you're getting, high teen or very high EPS growth for Nifty, somehow many of these expensive stocks which have become expensive at a time when economic growth or general growth was not where confidence was, they start taking a backseat. So what market participants have been trying to play is leverage to genuine economic growth coming back. See, yes, Fed is taking action, but that is because of the kind of economic growth that we've seen last year. And that has led to inflation. So this market will start falling more dramatically when the worry on economic growth takes up, becomes much more bigger. That is, economic growth will start kind of disappointing in a big way. That has not yet happened. Only when that starts happening will we have the next level of rotation. When economic growth is picking up, when people are talking of infrastructure spending, then it's really the old economy which comes back. That, after years of underperformance, had become value. And that's what is the sector rotation, which is it has been playing out. And I believe that that's not something which is over.
Vikash, how can we not talk about LIC, the big event? Wanted to understand what kind of implications could it have on market liquidity, given that the market is, as it is, a little brittle nowadays. And, whether or not LIC is going to find its way into every investor portfolio and every mutual fund house as well. I mean, is it really going to be the SBI, the big white elephant of the insurance world?
Well, I think, that's when that gets listed, we will answer the last two of your questions. But what is the impact is there was some nervousness on insurance as a sector. That there'll be another large listing which will take place. And I think some of these insurance names have corrected significantly going into this event. And perhaps once this is out of the way and this news gets digested, I would say that that sector has become quite attractively priced, even the already listed insurance space. So I think that is where the opportunity is once this gets listed. If we look at the kind of issue size that is coming out, it's something which should be manageable in terms of for the market to digest, because versus what has been talked about over the last year or so, the issue size isn't really, the liquidity which it could suck out is not really going to be that big.
Of course, today, noon time, around 12:30 is when we're going to officially hear from the LIC top brass. But Vikash, always great to have you on the show. Good speaking with you.
Thank you.
Okay, that's the word coming in from the house of CLSA.